Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at how determining how much you're willing to risk on any one trade is the first step in developing a successful money management strategy. In today's lesson we're going to begin to look at several different methods that you can then go about setting your stop once you've determined this, which fit within this initial criteria. So let's get started.
Okay, so as we learned in our last lesson, risking more than 2% of the total trading capital on any one trade is one of the major reasons that there's a high failure rate among traders. Does this mean that when setting a stop, one should simply figure out how much of a move in the instrument they're trading represents a 2% loss of their account balance and set their stop there? Well, while this would probably be better than many money management strategies I've seen, there are better ways. So although many traders are going to look at other things in conjunction with this, having an idea of the historical volatility or how much the financial instruments that you're trading moves is always a good idea when thinking about setting your stop level. For instance, if you're trading a $100 stock that moves $5 a day on average versus a $100 stock which moves $1 a day per average, that's obviously going to tell you something about where you should place your stop. As it's probably already clear here, all else being equal, if you put a $5 stop on both of these stocks, then you're going to be much more likely to be stopped out on the stock that moves on average $5 a day than you are on the stock that moves on average $1 per day. Okay? So while I've seen successful traders who follow a list of securities or a list of different financial instruments that they trade, get to know these get to know the movements of these instruments well enough where they have a good feel for what the daily range is and what the daily volatility is of those instruments. For people who don't have an idea of that, a good way of gauging what the volatility is of a particular financial instrument and in a way that many successful traders I know use is by looking at an indicator which is known as the average true range, or ATR for short. Okay, so developed by J. Wells Wilder, the ATR is designed to give traders a feel for what the historical volatility is, or very simply how much it moves. Financial instruments that exhibit high volatility move a lot, and traders can therefore make or lose a lot of money in a short period of time, all else being equal. And conversely, financial instruments with low volatility move a relatively small amount, so it takes longer to make or lose money, all else being equal. As with many of the other indicators we've studied in previous lessons, Wilder uses a moving average to smooth out the true range numbers, and when plotted on a graph, the indicator looks like this. Okay, so what you're basically seeing here is a representation of the average daily movement smoothed out with that moving average, 14 periods of moving average in this case. And as you can see, during the more volatile times in the market, the ATR moves up, and during the less volatile times in the market, the ATR moves down. So let's look at that here. So when the candles are small, this is a daily chart. So when the candles are small, that's going to represent days in which the average or the range of the market, the difference between the high and the low, is also small. So you can see here you've got many candles that are pretty small or relatively small, and so you have a narrow range, and the ATR is low as a result of that. Okay, and conversely, when the candles are longer, representing a higher range in the market, or a higher difference between the highs and lows of each day, then you're going to have the ATR rising. Okay, and what traders will look at a lot of times is the latest ATR number, which in this case is 114 points for the euro. And they will, when placing their stops, the most basic way would be to say set that stop a set amount of ATRs away from your entry price. So for example, set a stop 2 ATRs away from your entry point. So you say 2 times 114 gives you 228, and that's how many points away from your entry price you set your stop. Now, there's obviously things you can add into that, and that's, that we're going to go into in later lessons, but that will be one of the most basic ways to do that. And what traders are getting at here by doing that is they are trying to put themselves in a position where they give their trade a chance to move in their favor before getting stopped out, or without getting stopped out by random market movement, or just what's considered what's called market noise. Okay, so that's sort of the point of looking at volatility and what traders use that ATR for. Okay. So in addition, or lastly, the ATR, in addition to using it to look at the volatility of one financial instrument, just a side note here is that you can also use that ATR to compare volatility between different financial instruments. So let's say you're looking at two currencies or two stocks and you want to sort of see which one's more volatile. You can look at the average true range numbers for each of those. You can give you an idea of which one's the more volatile instrument. Okay, so that's our lesson for today. And tomorrow's lesson, we're going to look at how we can combine ATR with our 2% loss limit, and look at some other ways that we can, or other things that we can add into the picture to give us a more solid framework for placing stops. So we hope to see you in that lesson. The purpose of the InformedTrades.com community is to hopefully put together a community of traders who are looking to learn together without all the hype that's associated with most trading education. So if you haven't done so already, I encourage you not only to visit the InformedTrades.com site, but to actively participate. Every page on the site has a comment section where you can leave your comments and questions, so we encourage you to do that. As always, if you have any questions or comments on this video, please feel free to leave them in the comments section below, and good luck with your trading.